Hello, it's finally Friday, the 6th of September, and we're heading into non-farm payrolls, which is kind of the big macro event of the week. So I just want to talk about what the market is expecting and how it may react to, or potential reactions to, the non-farm payroll. So economists and traders are expecting the jobs report to show that the US created between 160 and 164,000 net new jobs, with the average hourly earnings rising to 0.3% from last month's 0.2%, and the U3 unemployment rate ticking down to 4.2% from 4.3% last month. So this is usually compiled, let's go to the right picture here, this is how all the banks put it together, and this is how we come out with a median. So if we talk about what the market reaction is going to be, and let's talk about the difference between a hard landing and a soft landing, because at the moment the market is predicting a soft landing. In other words, previously, when the Federal Reserve and the central banks have hiked rates, they tend to keep them high until something cracks in the economy, and then they start cutting rates very fast, and they're usually quite behind. Everything lags. Nothing lags more, by the way, than this payrolls report, which is not really a month old, but more than 6 weeks old. But that's how it tends to go. So what everyone is expecting at the moment, or has been thinking, is that we're going to get a soft landing. In other words, nothing's going to crack. Inflation's going to come down again. The Fed's going to cut rates and everything's going to be good, keep going up. And what some people are now looking for, now that inflation is coming down, the more people are looking at the jobs market for signs of cracks. Because if there are cracks in the jobs market, 50% of the Fed's mandate, they have two mandates, inflation and jobs. And so if there start to be cracks in the jobs market, then the Fed is going to cut rates faster than expected. At the moment, if they take the go slow approach, they're going to go next with a 25 basis point cut. And if the jobs market starts to show signs of weakness, the market is expecting a 50 basis point cut in rates this month. So what happens in this jobs report now obviously has outsized importance more than normal. So if we look at, this is what we're expecting. We're expecting around 160,000 jobs. I think if we don't get less than, as long as the market adds 100,000 jobs or more, and as long as we don't get our unemployment rate below kind of 4.4 or 4.3, if we stay at what we were last month, 4.3, and we don't add less than 100,000 jobs, I think that shows that the economy is strong. There isn't really any major cracks in the jobs market, and we can stick with the 25 basis point. I think only if we see less than 100,000 jobs or unemployment rate going up, like 4.4 or higher, are we likely to see a 50 basis point move. Now, 2.2 or 0.3, as everyone's expecting this to tick up a little bit, I don't think that the inflation move is going to have the biggest effect, but let's see. Now, we are in a bit of a scenario where good news is going to be bad news. At the moment, if the jobs market stays strong and the Fed only cut 25 basis points, which the market has more than priced in, I think that could be a little bit of a risk-off scenario in stock indexes, and it would see a stronger dollar. And the reason is that the markets like lower rates, and they want the Fed to cut faster, and they are starting to price this in. But if the economy looks strong, there is no reason for the Fed to change their kind of go slow approach. So I'm kind of thinking that we don't see a bad jobs report. I could be wrong, but that's what to expect. If the jobs report is good and it shows that the economy is strong, it could likely mean a little bit of a week off move in stocks and stock indexes, because I think we'll see another bounce in the dollar. If we take a look at where we are in this dollar index, we're kind of, if we take everything off here, we're kind of at a level where we could very easily see a bounce from here. We are sitting above this weekly 200 moving average, which previously has been pretty good support and resistance for week on end in this dollar index. If we take a look at the euro dollar, which is, let's face it, 57% of the dollar index, we are sideways underneath the monthly 50 moving average, which of course is sideways at our weekly 200 moving average, and a bit of a, a bit of a resistance level if we look historically at 112. And so I wouldn't be surprised at all if we saw dollar strength from here and we continued lower. Last week in this euro dollar, this was a nasty bearish reversal. For me, a bearish candlestick that remains in play unless we kind of get back above this midpoint around 111. So that's what to look for. A strong jobs report likely means a strong economy. The Fed will go slow, a stronger dollar, and we could see some risk-off moves in stocks. And that's kind of going to weigh on Bitcoin as well. I have always, I always look at time frames and timing patterns. I always thought that mid-month, I think September the 19th has been in my calendar for a while for when Bitcoin, I start looking for a bottom in Bitcoin, which means another 2 weeks of kind of pullbacks and sideways and potentially lower. And so we just need to be patient. This is very seasonal for September, and the best opportunities really do tend to come in October and November. No guarantees, of course. In fact, anyone who tells you they're about to make some life-changing wealth in these markets, I would block them. But I do think that, if you trade carefully, we do have some good opportunities or better opportunities to come. Good luck.